Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show for our special series, 6 days. Should have really come out with a better thing. 6 days of back-to-back podcast attack. The Fast 50 report. This is our final episode of our special series. Joining me in the studio, Paul Glossop. We've been unpacking, uncovering, extrapolating, analysing, addressing, assessing the really good lyrical rhyming gangster of property. How are you, mate? You well?
Very good, mate. Very good.
Yeah.
And, it's been a pretty cool ride going through the start and the birth of this, or the creation and the birth of this list, and now figuring out how does someone do something with this list.
Well, this is it. Okay. What do you do about it? I reckon, mate, this thing's been pretty hot. Lots going on, lots of noise around it. A lot of people downloading the report. A lot of people sort of picking through it, probably on their date nights, going, "Oh, look, one of our suburbs made the list! Hooray!" And I was actually chatting with one of our production managers, whose team has been putting the report together, and she invests in property, and she'd be tuning into this. You know who I'm talking about. She'd be okay with me talking about it, and she went, "Yes." And one of her colleagues, who you know also, both went, "Yes, one of our suburbs has been." Actually, one of them is a client of yours.
There you go.
And the lady I'm talking about isn't, but she independently chose one of these suburbs in the list from her own research, and she works really close with this other person.
When you're close to the source.
You're close to the source, there's to be fair, there's no reason for anyone that works with and within Momentum Media not to be able to get just a slight advantage on.
They're still going to do
property.
It.
You're still going to do the work.
You're still going to do the work.
You're still going to do the work,
property.
Right?
You're still going to do all the due diligence. That stuff doesn't change.
It doesn't change, and we've spoken a lot about this. But the point is, and as I've gone through this special series of the Fast 50 with you, Paul, it's raised or posed more questions than provided answers. And I've knocked around property a fair bit, so yeah, I know how to use a report like this, and a report like this isn't at the front of my strategy. This is sort of gets quite tactical. This is where the rubber hits the road using information like this. And I imagine a lot of people, unfortunately, a report like this, and because it's had so much attention, it might shape the way they go about investing in property, which might not be the most beneficial. They might start working on the details and the suburb locations, putting the cart before the horse, rather than going back to basics, actually understanding strategically everything else to do with property. And that's what you do working with your clients, isn't it? Like we're sort of at the tactical level talking about this stuff, and there's a lot needs to happen before that.
You're exactly right, mate. It's number one when it comes to what other things that we try to advise against is worrying about the outcome. To your point, strategy over tactic, and the tactic is essentially the product, and the product comes from a suburb. And this Fast 50 list is the suburbs. It's the end product of a much more of a detailed approach before we even get to a particular property or a particular suburb or a region or even a broader city. We really always, and if anyone's listening to this, if it's going to be your first investment or it's going to be your 50th, if it's your 50th, you've probably got a pretty good methodology. But if I say, look, it's your first, second, or third, and going back to an earlier comment you made on the previous podcast about foundational investing and buying properties that set you up for a much more of a prosperous retirement or early retirement or better financial future, you've really got to start with the end in mind. And I know it's a very flippant term that's used all the time, but you've got to make sure that is really what you're going to anchor this to. And it doesn't mean that whatever that end in mind goal is fixed and it's firm and it never changes. It's not a granite position to say that is exactly what it is and it never changes. But we need to start somewhere. And if your goal, for instance, in that example rather, is to say, I want to get to a point where I can replace a particular amount of my income within a time-bound actual objective. For example, I want to replace $80,000 a year income within 20 years. Very realistic and achievable for a large number of people if you're in your early mid-20s, even early mid-late 30s, depending on your starting position, depends on what you can do. And the reason why I say that's a pretty broad 20 years of time as a person, as an example. Typically, if a client comes to us and they're in their 20s, they're usually going to be using probably a limited cash deposit or potentially a guarantor loan from their folks or someone who's close to them. that allows them usually to get into property number one. If you're in your 30s, mid 30s, late 30s, 40s, and going into even late 40s, that client is still trying to get to the same outcome where they want to replace an income by retirement age, as well as better their overall position and pay off their home. But they typically come to us with a family home potentially already bought. Now, that home itself might already have a very decent loan attached to it, but also a decent inherent value. And in that comes a position of equity. So, for example, $1 million value asset that might have been bought 6 or 7 years ago with a debt of 600 grand. Now, if that's a 40-year-old person versus a 25-year-old person, their objectives might be exactly the same. I want to replace my income within a particular period of time, but they might be able to get more aggressive because they've got more that they can actually leverage. A younger person, whilst they've got more time to build a much bigger portfolio, they're limited by the amount of cash or deposit or borrowing capacity they have. So I guess ultimately that's sort of the starting position. Where do we go from there? So then we have to go down the pathway of understanding, okay, well, we know where we want to get to. So let's really start by anchoring, you know where you want to get to, you have some money attached to it, you have a cash flow amount attached to it, or you have a total equity position that we want to achieve by a period of time. We then have to be realistic to say, what can we do within the confines of serviceability? And to be honest with you, that's where we have to start. Because if you're not realistic on that front, then we can talk about all kinds of scenarios. And Phil, you've had more people, more guests on this show than I've had hot dinners. Like, you genuinely would have heard and seen every single bit of it, from multi-million-dollar commercial assets right down to literally one-bedroom units in the middle of nowhere and everything in between. And the price point would go from $150,000 to $20 million. It's all, you can talk about relative returns and fast 50 lists on all these different suburbs, and you say, great, if I bought that, I would have been set for life, but you just couldn't do it. So that's the part which partnering with an investment broker, partnering with your bank, and essentially really understanding those numbers. You don't have to do that before you come and speak to us. We can work with you to actually do those numbers live. Yep. And that's a really clear part. But that's where we're starting our conversations every time. And if you're not doing it now, that's what you should be doing before you worry about tactically how do you implement this list.
Yeah, and people are going, strategy, tactics, it's all fancy words I don't really understand. I'll break it down for you really easily. And there's something that happens before all of that, and that's what Paul has been talking about. It's your goal. What is your goal? What is your objective? What are you trying to achieve? Well, to your point, I want to replace my income as a worker with income I generate from assets, from investments.
Yep.
So that's your goal.
Yeah.
And at 65, however old you are, it's irrelevant. It's some people can move faster or not so fast, but that is your goal. Okay. How do you do that? Well, I'm going to invest in property, and I'm going to be buying a certain amount of properties at particular price sets. They're going to be able to provide me this, and the other. So at a point in time, I can get to an asset base. I can sell off half and then retire the debt. Then I can live off that. It's going to give me my income. Okay, that's your strategy. And then you get to tactics. And you go, okay, now I've got to work out which properties to buy and where. And largely, that's where this Fast 50 report sits and operates. It's quite far through the process. This is at the tactical level. Okay, I know I need to buy so many properties to get me to an asset base, a capital asset base of X number of $1 million. Okay, what is the makeup of those properties? And to be fair, that may change over the years that you invest as your capacity to earn becomes more, as your circumstances around wealth or the complexity of your family, etc., changes and evolves. So the Fast 50 is very much at the tactical level stuff. So don't get confused about it. Don't go to your buyer's agent. Don't call up Paul and go, yes, I want to buy a property in this suburb because it's in the Fast 50. You can go and get me one. The first thing he's going to ask you is going, why do you want to do that? Yeah. Would be what you would say.
Yeah, mate, you're exactly right.
And then you would say, do you have finance? Easy there, Tiger.
And I typically don't need to. I mean, the beauty about doing this for a very long period of time is that I don't even need to ask if someone has finance or not, because to be honest, whether you have finance immediately is a bit of a moot point, but understanding their total asset base as well as their income versus expenditure levels, that's vital.
How many people lie to you when you sort of sit in front of them and they go,
very little, to be honest with you, Phil. And you would think a bit the opposite, but I try to position it within our company. You position it very upfront to say, look, we're here. It's kind of like presenting to your GP. Look, I'm here to help you, but if you don't give me the correct information, I can't help you. Yeah. It's essentially saying, look, I can show you an amazing plan, and I can show you what dozens and dozens of our clients have done and built crazy portfolios beyond their wildest expectations. And it's happened plenty of times over. But if you give me false information, I can't lie.
You can't do your job properly.
I can't find that money out of thin air. And I've going to the theme of what we've done over this series, man. I brought up a live strategy email that I've sent to a client recently. Obviously, I'll de-identify them, but I'll walk through. I'm not going to go through holus bolus, what we go through, but I'll break down the sections that we go through when we're doing that live catch up. So for me, the key part here is saying ideally that person's already had a thought, or that couple's already had a thought about where they want to get to. So your point, they've already got a goal. That goal doesn't need to be...
They've got a goal, they've got a vision, they've got an outcome they're chasing.
And it doesn't need to be saying, hey, look, we want to be financially free in 20 years. It might be saying, we just want to buy our first investment.
It's okay.
That's fine.
I just want to start.
I don't need, and we don't need to have people sort of conduct thesis or PhDs on how do I get there. And our job isn't necessarily to say, here's how you get there, because to be honest with you, a 25-year-old presenting to us with a goal, that goal will change multiple times over their life.
But their goal might be, I want to be a property investor.
That's it.
That's okay.
And that is enough for us to start.
That's how I started investing. I went, I'll just start investing and then I'll work out what my strategy is.
It makes sense. You know that it's a good thing to do.
I'll work it out when I get there.
And I guess that's the first starting point, is that we and I break it down here, that the underlying part that we always starting, what's your current position? Mm-hmm. And current position might be just simply 1 or 2 points. And sometimes we go through pages and pages of his current position because it might have detailed assets, liabilities, etc. But current position for this one here, I'll give it some really brief bullet points. So currently living at home with minimal living expenses. So straight away, this person here, they were in their early 20s. They had a good job. They had saved some money. They can borrow really well because their out-of-pocket expenses are minimal.
So food, board, washing,
and the bank
everything.
Doesn't see what happens when you go on rent. Then all of a sudden that works against you from a borrowing capacity perspective. So currently living at home with minimal living expenses.
So the bank doesn't apply a rent, they will assume. If you're saying, oh, well, it's an investment property, I'm going to stay living at home.
They might apply a nominal board and lodging amount. So if you live at home, they might say it's $100 a week board and lodging. But you could also get a letter from your parents to say you pay nothing. Yeah. And literally it's an official letter saying they pay nothing. They live under my roof. I'm a parent and I treat that as my responsibility until they leave. But again, this person living at home, minimal living expenses, current approval. So this person's already sought the approval from a bank, current approval of $700,000, but looking to stick to a $450,000 to $600,000 price bracket. And that was part of the conversation.
What? Someone's investing in their means? No,
amazing.
Really?
And you'll see that.
Who would have thought?
The $450,000 to $600,000 is typically what we come back with, saying, great, that's your maximum, but let's pair off that maximum because this is their first investment and we know that there's future aspirations to do other things. So I don't want them redlining.
And this goes back to a chat we had recently, an earlier podcast around buying the right thing first, and hence the reason why for the fast food report, where to put your money today for the best capital growth. So this is let property do the heavy lifting to provide you with equity increase.
Completely.
So you don't have to worry about saving too much more money, but you do both side by side. You get the double whammy.
Double whammy. And this is a couple. So they're both living at separately at two different homes. Current incomes are $63,000 and $80,000. Okay. So graduate salaries, but they combined. They had a deposit. They've been working for 6 or 7 years. One of them went to university. The other one started a trade. They had a current deposit of $140,000 combined. So that was including closing costs. That was what they had available. What we also discussed was that they had that was what they had to their names. We discussed the fact that realistically we want a minimum 3 months worth of life expenses on that. And they sort of deduced the fact they probably spend somewhere about $3 or $4,000 combined a month. So we said, look, we probably want to keep 15 to 20 grand out of that as a pure buffer, no touch money. So that's ring fence. So we brought that back to about 120 grand that we actually had to spend. And then we discussed the next thing, which we've also covered at length, is 120 grand based on the fact that they've got a $700,000 maximum borrowing capacity. We brought that back down. But as we know, Phil, when you're first starting to build your portfolio, if you don't have assets to lean on already, the hardest thing to get your hands on is a deposit. Mm-hmm. You have to physically save that. You can't rely on the market to grow to all of a sudden turn that into a much bigger position. So the fact of the matter is we discussed LMI, because 120 grand at 20% versus 120 grand at 12% when you cover lender's mortgage insurance into that same equation changes the fact to say, hey, look, that might actually be 2 separate investments over the next 12 months versus one investment over the next 3 or 4 years. Does that blow
people's mind? Go, don't do one, do two.
And then it goes back to, well, but my parents always said that put a 20% deposit down. And then you've got to challenge them on where they're getting that information from. Yeah. And we're not pro LMI or against LMI personally. It depends on the circumstances of the situation. But as you also know, Phil, and we've spoken about it at length, the 2 biggest regrets for most investors is I shouldn't have sold and I wish I bought more sooner. And LMI is an enabler to allow people to buy more sooner. So we discussed that, and actually what we ended up with is saying, well, let's look at the short-term strategy. So we've got a really clear understanding, and there was a lot more detail to that current position. But the short-term position is that we already had finance somewhat approved indicative amounts. We talked about buffers. We talked about what we wanted to achieve. In that longer term is that really we're trying to replace an income. These people had, essentially, they had 35 to 40 years in the workforce. We thought we can bring that forward probably 10 to 15 years comfortably if we're starting on an aggressive purchase plan very soon. So talk about what's the immediate. Well, the immediate, we have to effectively get an asset into your portfolio. So we talked about that budget of 450 to 600. We didn't necessarily say that cash flow was going to be a constraint because they're living at home, they've got no living expenses, but it would become an issue further down the track. So as while they could save really easily, we didn't really need a high yielding asset, but we also thought, well, what happens when you do move out? Because they had plans to move out within the next 12, 24 months. Yeah. So we talked about the fact that saying, yes, we don't need a crazy high yield. We're looking for a growth asset first and foremost, but yield would still feature because we want to be able to service further down the track. So servicing was a key part. So 4 to 5% yield was kind of that target band. Ideally, the more the better, but we don't want that to be at the front end of the criteria, probably more the back end. So then we looked at that aspect over a medium term and long term. We detailed some more compounding figures over a medium term, detailed it over a 20 to 30 year long term. We walked through a lot of detail in regards to those two plans, but ultimately it came back down to saying, what do we look at first and foremost here? So we've got a current position, we've got a short term, medium term, long term objectives. Now let's figure out what the solution is to get that first step or essentially climb that first rung on the ladder.
And have you found anything yet?
I'm looking through this year. That meeting was 7 days ago. So the answer is no, we haven't found them anything yet.
You're waiting for the Fast 50 report to come in.
Well, I've actually sent them the criteria. So we've, out of this same email and this same conversation, we've sent them the specific suburbs which we see are going to fit that criteria for growth, for cash flow, establish freestanding assets with that yield target, and more so, and more importantly, the capital growth target. So right now, that's what we're doing and how we're working towards it.
Okay.
Yeah. So that really gives a very abridged version of what is a very detailed strategy meeting to then come to a solution. Yeah. And that typically happens over 1 or 2 meetings. But to be honest with you, all of that information we give away to our clients when they set up that first meeting. So if they walk away and do whatever they want with it,
they go and buy their own place.
They go and buy their own place.
Cool. Well, we've spoken about that, right?
We have. And there's always going to be people who want to do it themselves. There's going to be people who want it done for them. And that's our job, is to say, we're here to make sure.
Go, I've got everything for free. I've tricked them.
And I tell people, like, look, and obviously I'm saying this on a podcast that gets hundreds of thousands of downloads. I don't think there's any secret to us. I mean, there's other buyer's agents out there who won't give it away until you sign and pay, etc. This first meeting, we will go through this. And my job and my team's job is to say, I want people plan, and our job is to then execute that plan. Yeah. And that's really what comes down to us seeing the haves and have-nots in property, is those who plan typically get far more in the long term.
Yeah, and this is and it all comes down to execution. Yeah, the best plan in the world, if you can't execute on it, it's worthless.
And our job's to do both, obviously.
Yeah, to do both. But it goes to the point, and this, the Fast 50 report is very much at that implementation phase. This is all right. We've worked out, we know what we're doing and why we're doing it. This is like, how do we go about doing it now? This is when we get stuck into it. And a lot of these suburbs that we've spoke about in the Fast 50, we've done a lot of heavy lifting for you, that what a buyer's agent would do, because we've done an aggregation of all the best and brightest minds in property. But it still comes down to property investment it's completely individual for everyone. And this report, this Fast 50, it's a little bit voyeuristic, and that's why a lot of people like it. They want to know, they want to either affirm that they've made the right decisions and think they're ahead of the curve because they've purchased in these locations prior, or they might be looking for their next property, and this might just change and shape their mindset or their narrative towards it. There's still a lot of people that will only invest in real estate in their own state or in their own city. When you look at this, there's only one in the Fast 50. It's only one Tasmanian location. I think by memory there's only one Victorian location. The majority of them are in WA, Queensland, and South Australia. It's a handful in New South Wales. So, this may shape your narrative when it comes to where you invest in real estate. A lot of people are still emotionally connected with the property, and they need to be able to drive past it and feel it and touch it. I've got a lot of properties in Queensland. I've never seen one of them. And some people say, you're an idiot. And I go, well, I look at their results on a spreadsheet, and their performance to my ongoing sort of goals around property investment. So don't get too attached with your properties.
I'll share a quick anecdote. I own 4 properties within less than 2 kilometers of my house. Two of them I've seen when I bought them. The other two I saw based on surveys.
Yeah.
And none of which I've seen within the last 2.5 years.
You never do a drive-by?
As tempting as it is, mate, to go past a property and say, I own that.
Yeah.
Well, I don't really own it. The bank owns the vast majority of it. But does it change anything? I still employ a property manager. I still get the same emails. I still get the same phone calls. I only, in fact, got one as we're live on air saying the tenant's leaving, so we need to then do
increase the rents.
But this happens regardless if it's that property, if it's a Queensland property, if it's a Perth property. Irrespective, it's the same process.
And the good thing about the Fast 50 report, Paul, just to close the loop, is for many people, this might be the first time they've touched and felt or looked into property. And this might be, for many people, the catalyst for starting to have those conversations at home. It could be a conversation starter with a partner or something you can invest in. I see they're changing the legislation around investing now where you don't need to be an official sort of partner or de facto. You can actually now team up with a mate to invest in property, right?
And treating it the same way.
This is the same way. So this might be the conversation starter that gets people thinking around property. Now, I would caution that. Yeah, have a look at the suburbs, get a feel from, try and work out what's going on and understand it. But you got to come back to the point that Paul spoke about. You need to have an objective for doing it. And if you're just starting in property, it's okay if you say, my goal is to become a property investor. That's okay. You'll work it out when you get there. But you've got to have a strategy in place, and the strategy is where buyers agents can really help you to set yourself on the pathway so you can be those property investors that actually buy the first and the second asset, right? That leverage you into more properties moving forward by championing and running off the back of capital growth. And this report is very much about where to put your money today for the best growth in 2024. Paul, I think we can wrap up there. Any closing remarks? What do people want to do if they go, yeah, I really like the sound of this. You're talking my language. How do they sort of contact you and your team?
But yeah, absolutely. I think that in summary, the key here is that we've got a tactical plan with this Fast 50 guide. Now, don't execute it in isolation. Really make sure you take the time to plan and be methodical in that plan. Our job at Pure Property Investment, if anyone wants to catch up with us and go through that plan and actually go through what I've just talked about there, whether it's your first investment or multiple investments, purepropertyinvestment.com, there's an inquire now button. They can literally just click that and set up some time in my calendar. Alternatively, they can shoot an email to inquiry@purepropertyinvestment.com, or they can give us a phone call, 1300 985428.
Is that inquiry with an E?
E.
Yes.
E for egg. And I think one thing that I didn't outline there, mate, and I guess going back to that plan, and I was just looking through some emails as we're going live, is that what we also do, and probably 70% of my time at Pure Property Investment is actually spent catching up with our existing clients. And ironically enough, mate, what we do when we catch up is typically every 12 months after purchase, whether it's the first or the 15th purchase, we go through a holus bolus breakdown of the actual portfolio. And the intention of that is to go through basically what we've just gone through in this Fast 50 report. We go through a detailed, in-depth analysis of what's been the performance of that property that we've bought 12 months ago over the last 12 months. Is there enough equity in there to go further? Are your rents at the right level? Do they need to be increased? What's your serviceability look like now? How close are we to getting to the total portfolio size that we need to achieve your goals? Have your goals changed? Is it time to now start to consider selling down? The list goes on, but that's a big part of that ongoing part of achieving your goals. And Phil, I know, ultimately you've built your portfolio by doing that regularly. You don't just build it because ultimately you're too busy to take a time to assess it, or you need someone to proactively do it for you. Our job is to proactively put time in calendars and catch up with our clients. And that's an enormous part of my daily work, is making sure that our clients get serviced and achieve those goals the best way possible, and sometimes be given a bit of a push to get there as well.
Absolutely, and it's important. Property, people think property is set and forget. It's in a liquid asset, so I don't need to manage it and I don't need to worry about it. Well, as your portfolio get bigger, I'll tell you, it becomes administratively something that you need to look after. But property is definitely not a set and forget. You've got to always be reviewing, rethinking, reanalyze, addressing, all the different parts of your portfolio that's going to help. If you focus on the game of yards, and I can't remember the analogy of it all, but if your rents are at the right amount, if your mortgage is at the right amount, if you're understanding if there's any potential of your properties, how does one property associate themselves with another one? What's this whole holistic sort of view to shaping your portfolio? It's all important stuff, and I recommend sort of getting chat with Paul and his team. Paul, I'm going to close this podcast, and we haven't touched this at any other area, any other point of this particular podcast. Now, as part of our methodology, we didn't look at any. So there's a whole bunch of other recommendations come through.
Right.
And we spoke about this last time we got together on the best of the rest. We sort of have narrowed this down to 178 recommendations, right? We stripped out a whole bunch of properties because they had less than 50 sales.
Yep.
So that was our bottom rung was you had to have at least 50 sales over the course of the last 12 months to give a sense for, the sort of statistical significance of the information coming out of it, right? So it was a handful of sales.
Yep.
I'm not going to tell you a lot. What do you reckon? Here you go. What do you reckon the suburb with the most sales, and it didn't actually make the Fast 50. It was one of the best of the rest. Guess how many sold in the course of a year at the top end?
One suburb or
one suburb, one location.
SA, one group together.
One suburb, one postcode.
I'd have to say it'd be above 500.
Much more.
Yeah. But I mean, if we're talking, this is freestanding houses only.
Sorry, there's only out of the whole set 178, there's only 9 that sold more than 500 properties.
Yeah.
So it's I don't even know where this is. I should do. Baldivis.
Yeah.
6171. Where's that?
That's in Perth, mate. We actually bought a bit of property there.
You want that?
Yeah.
1,215.
Yeah. Hot tip, there's some new land releases in those areas. And this goes back to your point here too, mate, is that like data can say one thing, but until you have the ground truth, there's a lot of registered land lots in Valdivia that would all of a sudden skew the data.
And this comes back to the point about this being, you've got to get your strategy, your goals and your strategy right before you start getting tactical, because you go, oh, wow, it's really popular there.
Straight to Valdivia.
Well, so it's just greenfield stuff.
Some of it was established and then some greenfields. Yeah, correct.
Yeah. Point Cook, 3030. I imagine that's the same.
Another one.
Yeah.
Yep.
Craigieburn, 3064.
Another one.
845. So Point Cook was 1,103.
Craigieburn probably more an established suburb. Wouldn't be land releases per se, but big suburb, big SA1 catchment.
Redbank Plains, 700. That's Ipswich, is it?
Yeah, got quite a lot of new supply in certain areas of Redbank Plains.
It's the only way you can get that many sales, right?
Correct.
Really.
Correct.
Caboolture. 4510, 647.
Again, Caboolture West and that whole corridor is going, it's going exponential as far as growth, but new land releases.
Yeah.
Again.
Armidale, New South Wales, 2350, 540.
And again, regional, sort of, Tamworth-ish, but still there is some actual large land releases in that area.
So many clues. Anyway, Paul, this has been good fun breaking down the Fast 50 for 2024. Where to put your money today for the best capital growth for the next 12 months. Look forward to doing it again next time, mate. It's been good.
We'll review it, mate. I look forward to doing a review of the performance of this Fast 50 in 12 months' time as well.
Yeah. How do you reckon we'll go? Well, how do you reckon you'll go?
I reckon
nothing to do with this.
Well, mate, it's not just me.
I
can probably put my name
By the way, big disclaimer. Massive disclaimer. We've put this is a particular view or lens of property. We take no responsibility. No responsibility if you choose to use this investment. This is not investment advice. This is just one interpretation of property to give you a sense for how it all works. Anyway, apologies for the disclaimer, and I'm not joking by that. Just it might be a guide. Use it, whatever, but make sure you go and speak to the right people before you spend any money anywhere.
Absolutely, and I look forward to end of 2024. I reckon, or mid to end of 2024, we can genuinely do this a full review and figure out where and how. So
we're going to do a Q&A. So this is the 6th installment of this special podcast series on the Fast 50. We're going to give you a week or so, everyone, to digest it, all those questions. You can start sending them through editor@smartpropertyinvestment.com.au. We're going to do a live stream on it, but we'll make it so you can ask your questions live as well. So watch your space. It's going to be good fun. Paul, thanks for your time.
Thanks very much for having me, mate. It's been awesome.
Our major partner for the Fast 50 report for 2024. Paul and his team have done a great job. Been a real asset, done a lot of the heavy lifting as we've tried to analyze and interpret this information, but also how do we create a methodology to reflect what we're trying to achieve. That's the Fast 50 for 2024. Hope you enjoyed it. This is the first podcast you listen to. There's 5 other connected with this special report. Go and download it right now. smartpropertyinvestment.com.au. You'll find it. It's pretty easy. Enjoy it. Send your questions through. I hope it is of value. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.